We are live, and today we are talking about how to depain blockchain and in specific Bitcoin. So we want to talk about how we can kind of explain this at an intro level, make it less painful. And we're here today with our CBP committee. So I'm Jessica Levesque, C4's executive director, and we've got Dirk and Hunter from our committee here. And Dirk, do you want to get started?
Yeah, sure. Unfortunately, one of our members is missing today, I think, on his way back from Egypt. So, and Hunter's coming from us from Nova Scotia as well. So it's kind of a worldly committee today, not me. But yeah, like Jessica said, we wanted to kind of take some time here as part of a overarching theme with the stuff that the C4 is doing to kind of take a step back once again, as we do every now and then, and basically kind of try to help everybody when you run into that, like, crypto fanatic at a party, at least have an understanding of what it is that they're talking about when they start going crazy about blockchain. So um, wanted to start off with some really basic terms, and then we'll get into some more detailed stuff about what money actually is, and a little more detail about how blockchain and stuff actually works. But we wanted to start with this thing right here, which is the Bitcoin white paper. I think first thing, definition wise, a lot of people, you'll hear people talk about the Bitcoin white paper. If you're not in technology, you might not have even heard the term white paper very often. And so we'll just start right there, right? With a white paper is just a kind of an explainer document. It's an idea document, something that takes a concept and lays out the details of it. Sometimes it'll be on a specific, aspect of some technology or something, but it kind of just works as an explainer document. This particular white paper, which is super elegant, it obviously all fits on that poster. It's 9 pages long, and the ninth page is just a list of references. So really, it's 8 pages of mathematical and computational eloquence, explains the idea for this thing called a blockchain. It was written by a person or persons unknown, anonymously known as Satoshi Nakamoto. And so we'll start with the term after white paper. Satoshi obviously refers back, when you hear to it, both to the creator. It also refers to the smallest unit of Bitcoin, right? So a Bitcoin is a divisible currency, and a Satoshi, you'll often hear them referred to as sats. People will talk about stacking sats, meaning that they're just buying up Satoshis, trying to, collect enough to have a whole Bitcoin. So basically, you can think about it like dollars and pennies, right? You're talking about a smaller unit of measurement that adds up to the whole. But the real fundamental concept that was innovative out of this white paper was the blockchain. And there was nothing about a blockchain that was really just kind of fundamentally new technology. It was the unique joining of several other technologies to create this thing called the blockchain. And we'll talk some more about some of these terms I'm going to throw out here and explain them a little deeper in a minute. But basically, a blockchain is exactly what it sounds like, right? It's a chain of blocks. Each one of those blocks is a block of data that contains a bunch of transaction information, basically just like any old spreadsheet ledger, or even, old-fashioned book ledger where you're putting the ins and outs of money down and recording them so that at the end of the day who has how much money, what person owns this Bitcoin and what person owns these Bitcoins. And the excuse me, the really cool thing about it is the way that it goes together is that after that first block was created, each additional block, and so when a block is created, it includes what's called a hash, and that's the one cryptographic term I want to explain right now. Like I said, we'll get into some others along the way here, but it includes a hash, and a hash is a mathematical algorithm that is basically a one-way algorithm. It's really easy to like add up all the numbers one way, and really hard to go back and figure out what those numbers were that added up to that result. And what that allows you to do is, by creating a hash of the block, it makes it very difficult to go back and change anything in that block, right? If you change the smallest bit of data in that block, the hash no longer works, right? So it works like a checksum, a way of going back and validating the data in the block. And
And can I just add real quick to that,
yeah,
this information about hashes, I think the important piece of this is to know that there is math happening behind the scenes that provides this sort of security within the ability for us to understand that this is computationally accurate. And so you might not need to know all of the info about that, but what's important to know is that there are things that are happening kind of behind the scenes that the everyday Bitcoin user doesn't need to see and understand, but it's important to know what it's rooted in.
exactly right. And that's why we throw these terms out there a lot, because again, you will hear them. People will talk about the integrity of the blockchain. The hashing is a key element of what assures that, right? Because each additional block that gets added on includes the previous block's hash, and then it itself gets hashed, and that gets hashed. And so the ability to go back and change anything, right? You have this whole chain of transactions, and there is no way for anybody to go back and change that and say, no, actually, that's my Bitcoin, right? Actually, I own that money. You don't own that money. That the way that it's done makes it incredibly difficult, even with like, the most massive computing power that you can muster, to go back and change those things. And that's what's really key about that. But the whole idea of the chain of blocks is that the data builds upon itself in such a way that you can't go back and modify it. And that's what builds in, what makes it so unique and powerful as a way of managing transactions, managing accounts and money. Um, so I don't want to get more into the cryptography right now. We'll talk a little bit more about some of that in transactions, when we talk about transactions, and then when we talk about kind of more about the security of the chain overall and how that works. One other key thing that I think is really worth pointing out here is that Bitcoin and most cryptocurrencies are peer-to-peer. You'll hear that a lot as well, right? Meaning that I'm paying you directly. There's no middleman. There's nobody, it doesn't have to go through a bank. It doesn't go through a credit card company. It doesn't go through PayPal or any other sort of processor in the middle. Um, there's the Bitcoin is a network that is an open network. Anybody can, join it. And if I want to send money to Hunter, I send money to Hunter and it goes straight to Hunter. If I want to send money to Jessica, it goes straight to Jessica. There's no middleman in there that can control it, that can decide, hey, actually, I don't want like what you're paying Hunter for, so we're not going to let that payment go through. It's a direct peer-to-peer processing way of sending value. And then the last thing I kind of want to touch on is just this very word cryptocurrency, digital currency. You'll hear those used a lot. They are often used interchangeably. There is a subtle difference between them that's worth knowing about. Again, when you're chatting with your crazy cryptocurrency nut friend at the cocktail party. A cryptocurrency is something like Bitcoin. Again, it's peer-to-peer. There's no management of it. It's decentralized, and we'll talk more about what that term means in a minute. But true cryptocurrency utilizes the cryptographic algorithms to create all of the trust and all of the value within it. You will often hear digital currency. Digital currency uses a lot of the same technologies, but it tends to be representative. So you'll hear about central bank digital currencies, right? You might have a digital dollar. You have a digital yen is very, very big, right? Or the digital yuan, sorry, in China, right? Is a very, very big thing. But those are just representations of fiat currencies, of actual currencies within those nation states, right? They're not a standalone thing that exists on their own. Which actually I think is a great point for me to pause for a moment and to kind of talk a little bit about what currency even is, right, Jess?
Yeah, I think it's important. And this is one of those things where when I first started learning about Bitcoin, learning about it from this perspective, which we'll get into in a second, really clarified for me why it's useful and the point of Bitcoin. And so there are different functions of money. So in order for something to be considered a money, it is important to embody these three different things, which is medium of exchange, unit of account, and store of value. So let's start with medium of exchange first, which just means kind of exactly what it sounds like. Can you exchange something for another? So if we were to think like, okay, if I want to buy Lego bricks, which is kind of a common thing for me, I need to then supply something that Lego wants in return to give me the bricks. If I was to bring in a bunch of flowers that I grew and said, hey, Lego, I have flowers, can I have some bricks? They would say, absolutely not. We don't accept flowers for Lego because it's not a good type of currency. And it's not because who in the store wants Legos. You need to have something that you can exchange that they can then exchange for something else. So that's where currency comes into play. So if, like Dirk was saying, peer-to-peer, I was to send Bitcoin to Dirk in exchange for something, he then has the money. And so it's about valuing this as a type of money that can be used to exchange. And it's more universal than, say, finding someone who wants to exchange flowers for Lego. So the next piece, which is something that Dirk started to talk about, which is unit of account. So one of the first words we talked about was satoshi. And a satoshi is not only the pseudonymous individual or individuals who created Bitcoin, but it's also the unit of account, like Dirk was saying. And so just like with US dollar, we are able to say, okay, here's 3 pennies, 3 cents, which is 3% of a dollar. Same thing with Satoshis. It's a unit of account. You can break it up into smaller bits, which makes it usable. If there was just one large something, then you wouldn't be able to divide it so that it's able to be used in a functional way. And
If I can
then,
jump in there, Jessica, before you go to the last one, I think one of the things that's a term that is really, again, you'll hear a lot when you start talking about this stuff or listening about this stuff or learning about this stuff, particularly around the medium of exchange and the unit of account, is fungible versus non-fungible. The idea of a fungible, something that's fungible means one is exchangeable for another, they're identical, right? They're not, there's no difference between them, right? So $1 bill is worth exactly the same as another dollar bill. £1, sterling is worth the same as another pound sterling. It has nothing to do there's nothing unique about them from each other. So they're just totally interchangeable. And you'll hear that a lot when you start talking about this. Many people have heard of NFTs. That's a non-fungible token. They know it's called an NFT. The reason it's called an NFT is because it's actually unique. It's like it's a piece of art or it's a piece of music or it's something that is unique in its own way. And therefore, there's no one-to-one exchange rate for that, right? And so for a medium of exchange to be effective, it needs to be fungible so that, so like Jess said, she can hand the dollar to the Lego company and they'll give her some bricks and they can take that dollar and go buy something else with it, go buy plastic to make more Lego bricks, right? It's exactly the same value regardless of how it's being passed around.
and my takeaway from that is that you have the inside scoop on Lego reducing things so that I can buy something for just $1, which sounds awesome. So let's make that happen. Which actually leads perfectly into the next function of money, which is a store of value. So if you were to have something and it's currency, but it doesn't keep its value, then it doesn't really survive as a type of currency. And we're going to talk more about inflation and deflation and how it impacts currency. But I think the important thing to know about Bitcoin is that it has proven that it is a store of value because it is continuing to go up in price. And so obviously there are going to be detractors from that who purchased Bitcoin at a higher price and they're looking at it now and saying, what are you talking about? But then there's also going to be the people that purchased it a long time ago or, used it to be paid for goods or services. And they're going to see it as a great store of value. But the point is, if something just dissolves and no longer exists, it's not a good store of value. And that's one of the things that's pretty cool about Bitcoin is that it cannot just be destroyed because it's decentralized, which we're going to get into, like Dirk said in a little bit. It really provides this type of exchange, this type of money that can't just be erased by one person or a group of people that have decided that they don't think it has value anymore. And so that is the root of why it is a store of value. I don't know, did
And
you
I
want
think
to?
a really good analogy there or a demonstration of that, right, is we tend to pretty much everybody thinks about gold, right, as a good store of value. You buy gold, you know that over time it's going to be worth more. That doesn't mean the price doesn't change now, along the way, but over time it's going to be worth more. Versus if you've ever read about the tulip madness, right, the tulip craze, I forget exactly what years that was, but tulips are not a good store of value. They were selling for outrageous amounts of money, right? And you could grow them and use them as a medium of exchange because they were worth so much. They had so much value during that period. But they're not a good store of value because they're all going to die, right? At the end of the day, they're plants and they're all gonna die. So over the long term, you know for a fact that they're not gonna maintain their value for you.
And I just put a link in the YouTube chat about tulip mania. It's a pretty interesting, I guess, story, and it's true what happened in the Dutch Golden Age. So if you are interested, I think it's worth reading. It's pretty cool to read about. And another thing you can bring out at parties, because clearly there's plenty of content here that you can bring to your next party, as long as your next party has other people who like to learn. Just the best kind of party, I think. Let's move on to some of the other terms that we talked about that we haven't mentioned yet. So now we have kind of an idea of what makes a currency, but there are different types of currencies, which Dirk, you got to, but you threw out a word, fiat. And I've learned that that's actually not a word that just everybody knows. I think it's something that has grown based on, it's discussed more now, I would say, that cryptocurrency is something. But Hunter, do you want to talk about fiat versus Bitcoin and some of the things that differentiate those two?
Yeah, so let's start with just really what is a fiat currency. And a fiat currency is essentially one that is issued and maintained by a government. And it is as simple as that. And it can exist in, as Dirk referenced, it can exist in a digital form or it can exist in a physical form. But it is essentially a currency that is issued and managed by government. So governments have central banks, and they are really then managing the currency on behalf of the nation. The challenge with that and is that they can print more money, right? Has an unlimited supply based on the needs of the country. And there's different arguments about why they do that and what the benefit of that is, but it is a key driver of inflation. In terms of decreasing the value of the currency because there is not an upper bound on the amount that can be supplied. And so one of the key differences that was outlined in the white paper that Dirk referenced was the fact that with Bitcoin, there is only 21 million that are available ever. And this is where we get into really math and physics driving the whole ecosystem to put these constraints that give people a lot of confidence in terms of, right, Bitcoin has been running essentially for nearly sort of 14 years. And so it is becoming a more mature and a more trusted piece of technology to operate in exactly the way it's described in the white paper, which gives us trust in the process. And as we trust in the process and the technology, we can trust more in the value and the items that Jess had talked about in terms of it being a means of exchange, which for me, another way of thinking about that as a currency is like, I can hold it. It has potential value. I have utility for it in the future, which means I want to be able to accept it and then be able to do things with it. The second element of a fiat currency that I to highlight, especially in terms of the differences, is that a fiat currency has utility predominantly within your own national geography. So you don't incur fees when you are trading dollars for dollars, for the most part, especially when you're using it locally or you're using it with a friend and you're exchanging it. There's banking fees, which we'll get to, and we'll cover off some of the different elements. But for the most part, if you're going from US dollars to US dollars, it is a fairly efficient means of exchange from a cost perspective. But where it becomes very inefficient is if I wanted to pay a friend that's living in Japan or a friend that might be living in India halfway around the world, it becomes both very cumbersome in terms of cost and time. And so one of the designs of Bitcoin is, Dirk referenced it, a decentralized network that allows us to do the peer-to-peer transactions globally. And so we now don't have any borders in terms of where there are checks, where there might be friction in order to sort of send that money. And that is a real enabling and powerful concept, especially given that we are much more global, even than when the paper was written and when some of the early technologies were being imagined in terms of how this could be conceptualized. And now, if we think about sort of the opportunity with AI, we're moving it even further, right? Because now we can start to sort of think about machine-to-machine transactions, which actually is cost prohibitive in a fiat currency, but because it's infinitely divisible in terms of satoshis, and we can do it really quickly with algorithms and sort of mathematical checks, we have a greater range of applications for Bitcoin and for cryptocurrencies than we do for fiat currencies. So let me pause there. Dirk and Jess, anything to add in to the discussion just based on the opening of sort of fiat versus Bitcoin?
Yeah, I think one of the interesting things that you brought up is the borderlessness of Bitcoin. And going back to being at a party, and I'm sure we've all been somewhere at a dinner, whatever, when we say we're into Bitcoin and people give you that, really, why look? And often if you say, well, when was the last time you tried to make an international transfer? If you have talked to somebody who has tried to do this and maybe they're like, oh, I don't care about the fees, or it's fine. And then you say, oh, how long did it take? And you can hear, oh, well, it took 3 weeks, or it took 10 days, however long, and how that can be detrimental to business practices. Suddenly there's a use case for why this exists that I think is kind of hard to argue with, when I could send you money right now in Nova Scotia, Hunter, and it would take only a few minutes, no matter what it was that I was sending to, if I was using Bitcoin. But if I was using fiat, it would take a lot longer.
And a very specific example of that, because a lot of people will be like, well, I mean, like big businesses do that and stuff. International Airbnbs, right? International rentals. You try to this happened to us going to Scotland last time, right? Where we found a great apartment, but it was a local rental company. It wasn't it wasn't actually like Airbnb or VRBO or something. It was a local rental company, great property, exactly where we wanted, gorgeous place. But we had to do bank wires. That was the only way we could pay them. Because we had to pay in advance, right? Or at least put down a deposit in advance. And yeah, and it was an absolute nightmare, right? It's like we sent it to them, they didn't get it, we got it back, we had to send it to them again. Like it was, yeah. So that's a very real thing, just at a personal level, right? We're not just talking about businesses, buying supplies internationally and that sort of thing.
Yeah, and when we think about you think about the growth of MasterCard and Visa as payment networks, those networks grew because of the acceptance, right? Because of the global acceptance of anybody being able to have a piece of plastic and walk in and make a payment in the locations. And it wasn't global at first, right? It expanded, but they had to invest in that network for it to be able to cover it. And they extract fees because of the investment that they built out. And so Bitcoin really replaces that, completely decentralized and completely global, which, moving on to sort of then another key difference, is this idea of managed versus sort of unmanaged or completely decentralized, governed versus ungoverned. And one of the fascinating elements for me for Bitcoin that I really think is great is the incentives that are baked in, the economic incentives that are baked in to the network to provide the trust in there. And that, we'll get and talk a little bit more about mining, but because it's an open system, we have the miners are really protecting the security in terms of the validating the blocks that Dirk referenced earlier, right? They are making the checks that nothing is being exchanged inappropriately, and the people that own the coins, own the addresses, are the people that have the rights to them. and it's being exchanged, and we're not getting multiple copies of the same dollar. So that it is one Bitcoin is one Bitcoin, and somebody is not making copies of it inappropriately. And that's really different versus a centralized ledger, one in which somebody could go in and change the ledger on the database if they have the security permissions inside, and all of a sudden move your money out of your account into somebody else's account. There is not the same level of security and auditability for that level of transaction. And so that managed versus sort of unmanaged, governed versus ungoverned is a really important concept, because the people that are protecting the network get paid in Bitcoin. So it's inherently in their interest to sustain the security of the network as a whole, as a means to protect the value and protect the assets that they are getting compensated in. Because the other element of Bitcoin that is really important is that there is a physical cost of time and effort in order to do the mining that we will touch on in a bit. But this is where every Bitcoin essentially becomes a store of the cost of people's time and the actual energy costs that go into it, which underpins the store value, which Jess, you were referring to earlier.
And I think and a key element of all of that is that anybody can do it, right? I mean, that's the real like impact of being completely decentralized is if you want to buy the equipment and set up mining, again, Hunter said, we'll talk a little more about that at the end, but if you want to participate in it, you can do it. And you don't even actually have to mine. You can just participate. You can run a node on the network that just checks everything, that just looks at and agrees with, like just, sees the validation of all of the data flowing through it without actually having to participate in the cost of actually doing the validation. Anybody can participate, right? And that's, I think a key element of it being decentralized. Try telling your bank that you would like to count the money in the vault, right? That you'd like to actually verify that your account has the money in it, and see how that goes over.
So
Yeah, okay.
then I want to shift and cover off one last thing then around sort of fiat versus Bitcoin. And we've touched on a little bit about sort of inflationary currencies versus deflationary sort of currencies. And Bitcoin is deflationary in that there won't be more supply, right? And that the additional supply is what would drive up or decrease the value, drive up the amount that would be needed to buy something in the future in terms of the exchanged price for a given item or good. Whereas with a fiat currency, the central bank can print more. They can do that because there's a war. They can do that because there's a need of the people of the country, and they are making that decision to make that investment. But for anybody that holds that currency, that is devaluing your currency. And generally, right, central banks are trying to manage inflation somewhere between 3 to 6%. We know that there are countries globally that have hyperinflation, where their currency zeros get added on to sort of the currency when there's rapid devaluation. And so Bitcoin now offers this store of value where you can move fiat currency into a cryptocurrency, into Bitcoin, as a way of preserving your wealth. And that is a really important concept as people start to think about, how do I manage my portfolio of assets and be able to basically have them appreciate and have them maintain value wherever I might want to live, or whatever the economic conditions might be in different geographies.
And I think this is one of those really important distinctions that comes up a lot in like cocktail party type conversations, right? When you first start talking with somebody, after you get past but it's all imaginary, it's all made up point, right? And you get onto the next step, a lot of it hinges around this, because people will be like, well, Bitcoin's so volatile and, I'll just hold on to my dollar. And if you're talking about between today and tomorrow, right now, you might be right. But we all know, everybody inherently knows this, but we often don't think about it until we actually get involved in these sorts of discussions. we always talk about, well, okay, so that was $100,000 in 1930. How many dollars is that in today's money, right? We've all had that like conversation. We've seen that in, history books, newspapers, everywhere, right? This idea that today's money is not worth as much as it was then. $100,000 back then is worth $1 million today. Why? Because every individual dollar today is worth less. It takes 1 million to equal that 100,000 from back then. That's inflationary, right? That's the value of your dollar has lost value over time versus Bitcoin, which there was a really interesting publication recently. Hunter actually was the one who told me about this. A professor out of Texas did an analysis and found that even if you buy in any 2 to 3 year period, if you buy crypto at the highest value, right? If you're sitting here today and you say, okay, I'm going to buy crypto, and it turns out that that's a peak, within 2 to 3 years, you will have made money, right? You will have gone beyond break even and be making money. In like a 5 year period, you're outperforming any of the stock markets and Warren Buffett.
Hashtag not financial advice.
Right, not financial advice. I'm just saying this was a study someone else did.
Yes.
But that's a long-term store of value. So yes, we watch Bitcoin, go up and down, and everybody's like, oh, it's so volatile, I can't do that. If you're day trading, well, you can make a lot of money that way if you're smart, probably. But in general, yes, there is a lot of volatility right now because, like Hunter said, right, we're still in that maturation process, right? When we get to the point that there's 21 million and that's it that are out there, then that won't be the same anymore. And we'll see, I think, less short-term volatility, but regardless, the long term has been, as a store of value, going back to that, what makes a currency.
Yeah, I also think it can be kind of like US centric when we say that it's when we're talking about the store of value or like the devaluation of cryptocurrency or currency in general. If we're looking at it from the perspective of a different country's fiat currency, then it could be very different, because I know people who live in countries where their government currency, their fiat currency, is constantly devalued. And so, and it is kind of really impacted their livelihood and their ability to function. And so they would prefer to get paid in Bitcoin, because even though it's volatile, it's safer than perhaps a Argentinian peso or, whatever it is that somebody usually receives for work. So they prefer Bitcoin.
Absolutely. Yeah.
Well,
And it's like,
and has greater utility, right? I mean, there are now companies and activities globally that allow people. I work at a company called Salt. We sort of lend against Bitcoin assets, right? People have. I mean, one of the most exciting things for me around Bitcoin is it really now is an asset that anybody can manage as if you were a billionaire. It is an asset that you can borrow against it. You can create liquidity against it. You are not having to sell the asset, and you are able to still retain ownership of your asset with an opportunity for it to appreciate. And that is a really unique wealth management strategy that predominantly had been preserved for people with lots of real estate, lots of equity assets, the purchase of stocks that provided dividends as a way to fund their lifestyles, that is now being made available globally, and I think creates a great opportunity for the participation in the ecosystem and with the crypto asset in a way that is, I think, and Dirk and I've talked about this before, is really helping open up banking to billions of people that have largely been what is referred to as unbanked. They haven't had access to banking for good reasons, for bad reasons, but they had, Bitcoin really helps them overcome those hurdles, whatever they may be, to be able to provide financial services for themselves and their family.
Yeah, and at least for me, that's why I started, I think actually for all three of us, why I started to be interested in Bitcoin in the first place was this idea of banking the unbanked. And that's what got me into wanting to learn more about it to begin with, because of sort of the foundation of it, where the idea of it and how it can be used to impact society for the better. And then often the detractors are focused on just the negative, but not these other pieces that can be really incredible for societies that need that help with in terms of the currency being used.
100%. Yeah.
Well, Hunter, you were talking a little bit about actually having Bitcoin or holding it. And maybe we want to talk about what that even means and looks like. So it's different than, having a $5 bill in my hand. What does it look like? How do we actually store it? Because like we've said, it's digital. So what does that look like? Dirk, do you want to get into keys? I know you said keys earlier, but maybe explain what that means.
Yeah, so this is the nuts and bolts, right? Everything up till now is like, okay, sounds great, right? Oh, that's really cool. Awesome. You can do this stuff with it. How do I do it, right? And this is where, for a lot of folks that are even interested in the potential of cryptocurrencies and Bitcoin, things still break down a little bit, right? Because we're still, again, in that maturity, things have gotten wildly easier to do than they used to be. But there still is kind of this, okay, so now I've got to, how do I go about this, right? But it's kind of like going and opening a bank account for the first time when you're, if you are banked, when you're, whatever age. So to actually send a transaction, right? There's a couple things that we need terms we need to kind of clarify here. The first is, how do you hold Bitcoin, right? And the way you hold Bitcoin is you have a wallet. What is a wallet? A wallet is a numerical address on the blockchain, right? And so your wallet is where you can go and again, because this is an open and decentralized technology, anyone can go look at the blockchain. There are blockchain explorers out there on the internet, and you can go look at the blockchain, the Bitcoin blockchain, the Ethereum blockchain, whatever, and you can go see how much Bitcoin or how many satoshis sit in every wallet on the blockchain, right? That's what the balancing, the ledgering that we were talking about earlier is keeping track of. You can go see that. So you have a wallet, that's an address that's assigned to you. How do you get that wallet? That wallet is based on the creation of a public and private key pair. Now, we use public key cryptography with public keys and private keys every day and don't think about it. Every time you go to an HTTPS website, right, you're using public key, private key cryptography. What's happening behind the scenes on your computer is the server out there has a private key. They've published the other half of that key, which is their public key, and you can use those to validate that you're actually at that server, that the data between the two of you is being encrypted. This is the kind of background cryptography that, like Jessica was saying earlier, right? You don't actually have to understand how all this works. You don't actually have to do all of this, but it's good to know that this is what's happening behind the scenes. So we talk about the wallet address is that thing actually out on the blockchain. Wallet also tends to get used as a term for the applications that let you interface with the blockchain, right? So I can download a wallet app to my phone. There's tons of different wallet apps out there. Always go for well-known, well-trusted and respected wallets. And so I download a wallet app to my phone, and the first thing I have to do is create that key pair. Again, the wallet application is going to do that for you, right? It's going to generate these keys, and it's going to store your private key. It's going to walk you through the process of manually backing up that using a series of words so that if you can recover that if your phone gets lost or dropped in a lake or something like that. But it does all that in the background. It creates that, and you go. And then you have a wallet. You now have that address out on the blockchain where you can send data back and forth. So you have these keys, lots of cryptography going on there, but you don't have to understand how all that works. You have a wallet app that creates them for you. And now you can log into your wallet and somebody can send you cryptocurrency. They can send you Bitcoin to your Bitcoin wallet, and then you can send them from that wallet. A lot like using Venmo or PayPal or any one of these other tools, the difference being it's not really just a representation of dollars. You're sending that actual Satoshis or Bitcoin directly to the other person in that peer-to-peer way we talked about earlier. So sorry, Jess, did you want to?
I was just going to jump in and say that we have a ton of different educational materials to help you learn more about this. So I put in the chat a link to our hardware wallets course. Previously, there's one for our Bitcoin course, and then also some free articles just about how keys work. So if you want to go down that rabbit hole, you've got that option for you. If you want to keep it more high level, then you don't need to dive in any further.
Right. So that's wallets, addresses, and keys, kind of in a nutshell. Another one of those terms that they often hear and that can feel kind of confusing initially is UTXO, or unspent transactions. And what that is actually pretty simple, fundamentally, but when you start trying to look at it mathematically, it feels weird. It's change, right? A UTXO is just change. And so the easiest way to think about this is I want to buy something from Hunter, cost 10 bucks. I only have a $50 bill in my wallet. I hand that $50 bill to Hunter and he gives me $40 back in change. That's exactly what happens on the Bitcoin blockchain. And this is one thing where different blockchains work a little bit differently. So this can vary between blockchains. But on the Bitcoin blockchain in particular, that's how it works. So I have a wallet, it has some money in it. I want to buy something from Hunter. I send the money out of that particular address to Hunter, and then he sends back, and he doesn't have to do this, right? This is just how the network does this. You're not relying on the other person to do this. It sends back what wasn't spent, what didn't need to be spent, to an address in my wallet. And so that's kind of when people first start talking about UTXOs, it sounds really confusing, but at the end of the day, it's actually pretty straightforward and simple. And again, it's all done by it's not like the cashier could just take your 50 and run off with it, right? It's all just happens automatically in the network in the way that the transaction is processed.
I think one of the important reasons to understand that is that when you are actually doing a transaction and then you want to check a blockchain explorer to see what that looked like, if you don't understand just that there's a UTXO model, that there's going to be a change address, when you look at it, you might be kind of confused or concerned about what's happening. And again, it's pretty simple once you look at it, but I do think it's just important to know that your money has not disappeared. It might look different when you check a blockchain explorer to see what the change and the change address is doing.
Right. Especially if you're watching it as it's happening. And the other side of that is within your wallet, you may have multiple addresses that each have some money in them. And in order so maybe none of them have $10. Maybe one has $3 and one has $2 and one has $4. It's going to put those together to send that. So when you look at what actually happens on the blockchain, your transaction might actually be $3 coming from one wallet, $4 from another, and $5 from another, and then the change from all of that coming back to you, right? I shouldn't say wallet, addresses, right? They're coming from different addresses out of your wallet. Because that's how the network works in order to manage the balancing of the ledger. But that's at the end of the day, really getting involved nowadays, right? It used to be that like you had to download software to create wallet addresses online, and then you had to oftentimes kind of manually put together transactions in order to be able to send crypto from one place to another. And the one thing that I didn't really cover there, going back to the whole public key, private key thing, what's happening is your public key is associated with your wallets. That's the wallet address that's out there on the blockchain, right? That's derived. So what that allows for me to do is to send money to you and to be able to verify that had to come from the private key that only I can hold. So when I send that $10 to Hunter, what I'm really doing is I'm signing a message that says, hey, this 20 Satoshis of mine is going to this address that belongs to Hunter. And because of the mathematical relationship between the public key and the private key, anybody can look at that public key and verify that the only key it could have been signed by was my private key, the key that only I have and only I know, and therefore it's a valid transaction. Again, none of that is something you have to do as an individual. It's all happening behind the scenes, but it's what's layering on the validity, the integrity, and the security of the system.
Yeah, and I think that's a good segue into what actually secures this system. And we've thrown the word mining out there a couple of times, but why don't we explain what mining is, what it looks like from a high level, Hunter?
Yeah, I'd be happy to. And I think it pulls a number of the concepts that we've talked about together. Mining, and I don't believe it's the best name possible in terms of for what it really does, but it is the security of the network. And I think that's important to point out, because that's different to any one of us securing our own private keys and managing our wallets. The miners on the Bitcoin network are securing the network. And so their role is to basically solve a cryptographic puzzle every 10 minutes. And one of them gets rewarded for doing that. And that is basically validating what Dirk talked about, all of the different transactions within a block, that they all have been signed, that people who are transferring money have signed it with appropriate private keys to release those addresses, move that currency to somebody else. And they are solving that within sort of a 10-minute block. And what's interesting is they are having to invest the time and the physical assets and the energy assets to do that. So one of the questions that comes up all the time, that Bitcoin is not backed by anything. Well, I don't think that's true. Bitcoin is backed by the investment in energy and time, actual power costs that people do to the mining. And so once they validate the block, they then get a reward. So they are getting compensated in Bitcoin. And Bitcoin is that reward. When we talked about sort of the curve of how much Bitcoin is available, there's an algorithm that states it sort of starts to reduce the reward over time to at some point where there won't be any sort of reward, but there are transaction fees that miners get for the sort of completion of a block, the mining of a block. And so you can think about that as they are providing a service to the network and they are getting a reward. Some of it is in the mining reward that they get in terms of Bitcoin, and some of it will be in the transaction fees that they collect. And that ratio is changing over time. It started off, it was very highly weighted in terms of it being Bitcoin with very low, if any, transaction fees. And we're moving into a space where now, if you want to make sure your transaction goes through in the next block, you then increase your transaction fee. And the market is starting to dictate what the transaction fees are, and miners are starting to get compensated for that. I think it was last year in May-ish time where for the first time ever, the transaction fees exceeded the block fees, the block rewards. And we're starting to see that happen more frequently as more and more volume is going through the network. So it gets referred to as mining, but essentially it is a security service. It's a security function that's being performed. And the people that have the computers that are providing that power, the compute power that are paying for that processing capacity, are being compensated through both the block reward and the transaction fees that are associated with it.
And this is how the network remains decentralized, through miners that are on the network all around the world. That's part of why it's global, and it's also related to the immutability aspect that we talked about earlier. It's not just one central body making a change on it. It's all of these miners coming together to solve a puzzle and reaching consensus on what the answer is.
Exactly. And I think that's really important, because it can start to sound like there is this central, like it is like PayPal, right? Like there's this centralized sort of, authority out there in these miners, but that's not the case, right? Like I said earlier, anybody can participate, anybody can set up and start mining. And the way that it works is that every time you sign one of those transactions in your wallet, it broadcasts it out to the network and it gets picked up. And the miners start trying to do that puzzle, basically, that Jessica said, right? It's a mathematical puzzle that they have to solve utilizing the transaction. And they start trying to do that. And the first one to do it is the one who gets the reward. The first one to do it is the one who then puts it into the block, gets the reward. The other miners all validate it, right? There's this process that makes sure that, oh yeah, that actually is the right answer to the puzzle. Because again, it's one of those hash type things, right? Where it's in this case, they're going backwards, where it's very hard to solve the puzzle and therefore be the one to win it, but very easy to look back the other way, right? And say, oh yeah, nope, that's the right answer. Very simple to validate that. So it's not like there's a central authority of miners out there that are, that are controlling this. Anybody can jump in and start mining at any time.
Well, we have been on for a little less than an hour, and I feel like we have covered so much of the basics. I'm impressed. It's almost like you guys know what you're talking about, and that's why you're on the committee.
Not just us.
But I think that there's so much more you can get into. This is a good overview, like you said at the beginning, Dirk. If you're at a dinner party or you're just hanging out with friends and they're like, well, what is Bitcoin? How does it work? Now at least you've got some of the tools, that some of the terms needed to be able to explain it to others or to understand it yourself. If you want to join us going down the rabbit hole of learning more, we've got tons of resources. So please check those out. They're both free and paid resources. So please head to our website and check it out and see what can be helpful for you. And maybe if you are interested in it, you can become a certified Bitcoin professional, which really proves that you understand all of the inner workings and outer workings of how Bitcoin operates. So Hunter and Dirk, thank you. This was fun as always. Anything else you wanted to add before we head out for the day?
I don't think so. Thank you, Jessica. And yeah, it's very easy to start down that rabbit hole. So apologies if you do.
Okay.
No, I would just say thanks again. It's a pleasure to be able to do this. And if the resources at C4 are very helpful as people want to learn more about it and tap into the resources. But one of the best ways to do it is just buy a little and start sharing it with friends and experience it for yourself.
Yeah, I like that. Thank you both.